Federal Reserve, of course, held its key interest rate steady. With rates at a 23-year high, the Fed says that they do not have the confidence to loosen policy, signaling only one rate cut this year. Our next guest says that investors shouldn't get too caught up in the level of inflation, but rather the inflation volatility and what it might say. So how can we look at inflation volatility to determine the odds of a market advance, for instance? And where is she seeing opportunity in light of the Fed's announcement? Here today to discuss her current market thesis and for a look at which sectors are on her radar is Fidelity Director of Quantitative Market Strategy, Denise Chisholm. Hi, Denise. How are you?
Hi, Pamela. I'm well. How are you?
I'm very well. Great to see you. And very grateful that you're here. We'll invite everyone else who's here to send questions in for you over the next little while. Let's talk about volatility. We've got an awful lot of economic information over the last week and a half. It's been all over the place. There's lots of things that show a little bit of weakening. The vol and the market reaction to the inflation volatility is interesting. What do we do with it?
Yeah, it's interesting. I think that the market has become very data dependent, much like the Fed has become very data dependent. And I think that we look for daily moves as something of predictive for what market returns might be or what the reaction might be. And when you look back historically, those daily data points and those daily moves are predictive of not much. So you really need to step back and assess the data, assess anomalous data, and then assess the odds from that anomalous data. And what's interesting with, while we're all focused on, is CPI going to be plus, 0.1, 0.2, or 0.3? Is it above or below consensus expectations? Quietly, the inflation volatility, so the standard deviation of that year-on-year rate, has actually fallen back down to the bottom half of the distribution of its historical range.
Wow.
And that is actually more important than the overall level that you see associated with inflation. And we've talked a lot about, in the 60s and the 90s, where inflation ran above what is currently the Federal Reserve's 2% target, and stocks really had no problem with it. And I think that what you can look at in the data is those times were unique in the sense that CPI inflation, or PCE deflator, whatever you'd like to measure, might have been running a little higher, say 3 to 5%, but the volatility was actually lower and the market did just fine. So I think it is a mathematical representation of, look, it's not just the rate of change that matters, it is how volatile that rate of change is that matters to the markets and to corporations.
So this is exactly the question of, everything with, are we going to get another hike? And if we're not, that's its own story, because at least you can plan at a certain level, right? I mean, even if it's awfully high in many people's opinion, you can plan. Is that why low vol is important? You can plan with low vol.
That is exactly right. I mean, the biggest problem for corporate planning and corporate profitability is uncertainty to the outlook. You don't know how to plan, you don't know what your CapEx should be like, you don't know what your input costs are, therefore you either make no CapEx plans or have to change them, which is usually more costly and a problem for profitability. So the less volatility there is, especially in pricing, the more likely corporations are to be able to execute against it. And I think that that's exactly what you are seeing with a very sharp profit recovery, despite the fact that inflation is a little bit higher than the Fed would like. And I say a little bit because it's not a lot, a little bit higher than the Fed would like, and policy is still restrictive.
Okay, let's bring in the shelter story. And there's other things to say in between, but shelter is one of the things that is the sticky piece of the story, and that is holding inflation higher. Weave that through the story for us, because it's obviously, it's a third of what people pay, or way more, in terms of their income and where it goes to. It's a really important piece, even if you pull it out of core.
Yes, I would say it is the entirety of the reason that inflation is sticky. It's not one piece of the puzzle, it's the puzzle. And you can see this very visibly when you look at core inflation or the core PCE deflator, whether you're measuring the CPI or the PCE deflator. When you look at core, that's ex food and energy, right, that are sometimes driven by supply shocks. So the Federal Reserve doesn't want to use their monetary policy to sort of, assess something that could be driven by supply shocks. Once you take shelter out along with food and energy, what you find is the CPI that runs a little bit hotter than the PCE deflator by average of about 50 basis points, That is actually on a year-on-year rate, given the data point we just saw yesterday, is below 2%. Listen, what that tells me is outside of shelter, the Federal Reserve does not have an inflation problem.
Wow.
Shelter is
I feel like you need to say that again. Really? So the inflation story is actually in one particular area.
Correct. And one could argue, and I'm always curious why nobody does argue this in the Q&A after the press conference, but they don't invite me to the press conferences, why nobody talks about the fact that this is a shelter problem. And ex-shelter, there really is very little inflation problem. We can pick apart core services, ex-housing, but again, that isn't very different from what we've seen in history, and it's being more than offset by deflation or disinflation, sometimes deflation, in goods. So you net out those extremes on both sides, and what you come up with is 2%.
That's really, which is target, and even if it's slightly below that. So tell us a little bit about how the consumer sort of fits into this story, because it has to do with which sectors you're going to be looking at and so on. I mean, the general story is everyone's paying very high interest rates, or this is a Canadian story, is about to pay much higher interest rates. Different story in the US, but still kind of a developed world housing / shelter inflationary story, right? I mean, they're all fighting it in some way, and the central banks are kind of trying to meander through this.
They are trying to meander through it, and it is always different this time. So the recognition of how it is different is important to monetary policy, and I think the Bank of Canada called it out specifically. And I think the Federal Reserve doesn't call it out specifically, but does actually get it, in the sense that shelter is very different this cycle for two reasons. One is because it is being driven by a supply shock. When interest rates went up in the US, and this is true in Canada, well, then nobody really could move. What does that do?
When you say supply shock, that almost sounds like an OPEC supply shock. This is the magnitude of what we're talking about.
That's exactly right. So the rise in interest rates actually created the lack of supply. You could argue that a fall in interest rates will unlock potential supply and actually quell permanent pricing. So it's an odd thing in terms of the monetary policy impact on something calculated like that, or something that is a structural part of the economy like that, is very different from whether or not you're going to, consume hotel prices or airline fares or, apparel, clothing. That's not that marginal propensity to consume. This is a very, very different animal. And I think the Federal Reserve gets it in the sense that when you look at the dot plot, what does it say? They took up their inflation forecasts, which a little, right, and took up their, potential for rate cuts. But there is still a rate cut in the dot plot, despite the fact that inflation is well above core, because they understand that this is being driven by shelter. And oh, by the way, the complication of calculating the price effects of shelter are the fact of what would you like to calculate for the price of houses? Would you like to calculate the marginal cost of a house, the change that had happened over the last 6 months, or would you like to calculate all the rents and all the houses? And therein lies the rub, because this will always be a lagging indicator to what, there's no true shelter inflation, but what shelter inflation really is. Over time, those average prices will then gravitate towards the incremental prices that we have seen already fall. So that's the struggle with, I think, what the Federal Reserve understands, which is to say that they do want to be cutting while inflation is falling, even though it's above target.
So it's interesting. You and I discussed something, sort of a report that was floating around, just discussing how central banks, in the midst of this sort of being mired in this shelter story that's hard to navigate, should perhaps, this is one of the suggestions, just focus on the rest of the economy and sort of focus on how the rest of the economy is doing, where inflation sits there for everything else, and sort of either fight it that way or view it through that lens, rather than trying to deal with the shelter thing. I mean, it sort of sounds like it's impossible to deal with the shelter thing. I don't know if that's correct, but what do you think about that? Focus on the rest of the economy and the inflation there.
I think that's right. I think that's exactly right, because your pricing is much more clear there, is not lagged. And I think you can make the argument that central banks are in fact doing that. It is certainly an easier situation. And again, I think it goes to the fact that central banks for many, many years took out food and energy because of these potential for supply-driven shocks. If there is a drought somewhere, food prices are going to be higher. Why would the Federal Reserve raise interest rates to offset a potential drought? Same thing with a supply shock in terms of crude oil. If there's a war, that's going to drive up crude prices, and therefore the Federal Reserve doesn't necessarily want to be hiking rates to quell that kind of inflation. I think that they are understanding through time that there is a supply-driven phenomenon in shelter. So to the extent that you can remove that and look at the rest of the economy as through that lens as, okay, what really is pricing right now? And are we comfortable with it right now? With the assumption that over time, you will see shelter gravitate back to trend when A, you solve the supply and demand dynamics, and B, when you have enough time for this lag data to catch up to incremental rents.
So interesting. So what should perhaps maybe we're getting too into that, but if maybe the capacity story of crude oil, drives the price as much as a few other things, and that's maybe less of a concern than it was 20 years ago. But housing is more of a concern. Is there a new type of reporting, calculating of inflation that we need to be looking at?
Well, Europe, and it might be Canada as well, do actually calculate inflation ex shelter. Yeah. The HICP. Yeah. So, I think that what you are seeing is maybe that the Federal Reserve will start to migrate to that. I think that there was a hope, and Chairman Powell really talked about this early on, that shelter would be coming back to incremental rents quicker. But there was a methodology change in terms of weighting new homes versus existing homes that they just did over the last couple months that I think delayed that to some extent. So you don't hear the Federal Reserve talk about it a lot, but I do think that we may very well gravitate to that area where, look, if we didn't change the way that shelter was reweighted, we would actually be a lot closer to target. Or mathematically, our target, what used to be 2%, is now under this new calculation, really something more like 2.3 or 2.5. I think you could see a change over time in what the target is, how they think about the target, what upside they allow around the target, and how they start to talk about that. I don't think that you'll see it anytime in the next couple of months, but I do think that you will see it structurally, because when you look at the rest of the pricing, again, you really don't have an inflation problem outside shelter.
Okay, fascinating. I want to pick up on a couple of things in there. So you said probably not in the next couple of months, but that seems to take off the plate, Jackson Hole, okay? But that would be an appropriate place to sort of discuss, is there going to be a new target rate for inflation, and is it 3 or is it not 2? Anyway, but you think over time that can we connect this story of targeting to the debt story, to the for some people and investors certainly, the unbearable weight of the debt load ultimately in developed countries, in the United States, all over the place, and the idea of inflating your way out of it?
Yeah, I think it might be a little bit Pollyanna-ish to think that we can inflate our way out of the debt story. And I think that that's, when I look at that inflation data and I say, really, there is no there, ex shelter, to me, this cycle then doesn't look a whole lot different than the post-financial crisis era in terms of pricing. I don't necessarily think as a long-term, the end of cycle, which I don't know when the end of cycle will be, but eventually it will come. That cycle, end of cycle, is starting to look more deflationary than inflationary to me. And I think that that's all wrapped around the fact that inflation is much harder to get, I think, than we think. There was a lot of money dumped in a very short period of time that we have not then really had the same amount of fiscal stimulus in quite the same way. And I don't think you are likely to see that inflationary impulse. And in fact, we saw the biggest deceleration in inflation in history outside any recessions. So if that is happening outside a recession, at some point there will be a recession. And at that point, deflationary recessions are typically worse than inflationary ones.
Right. Right. They're harder to climb your way back up.
Correct.
So interesting, and that explains, sort of best part of the last 20 years, and the story of what central banks are trying to grapple with. Questions coming in. So based on all of the things that you've laid out here and discussed, and where inflation sits and perhaps is going in different areas, let's get into the sectors themselves. How does this story affect how investors invest, and which sectors broadly they take a look at? Interest rate sensitive or not?
Yeah, so I'm still interested in interest rate sensitives like financials and real estate. That has not worked to date, right? I think that you may very well have to wait for a Federal Reserve cut. And I think that that's a possibility. But to me, your risk reward is still skewed to the upside. What you see is, you're at trough levels on relative price to book, and in some cases, absolute price to book for financials. And in real estate, very similar situations in terms of the relative valuation or valuation spreads suggesting a whole lot of fear. So that changes your risk reward. So if you say, okay, there is a risk, Denise, that the Federal Reserve hikes interest rates and these interest rate sensitives are worse off, or there is a risk that the Federal Reserve cuts and they're uniquely better off, that I think is more like a 2-to-1 payoff. In the sense that I'd say, if the Federal Reserve cuts, you might have double the upside as the downside if the Federal Reserve hikes. Because the way I look at the data, those wide valuation spreads tell me as an investor that a whole lot is priced in already. So if you are scared as an investor that the Federal Reserve may in fact have to hike or may make a policy mistake, I will tell you that I see that empirically in the data. So to the extent that it happens, there is less downside than you might think. Wow. To the extent that the opposite side, we assess that the Federal Reserve cuts because maybe Denise is right, there is no there to inflation. I think it looks more like a coiled spring to me, where there's going to be a whole lot of upside, probably in terms of multiple expansion, right? Earnings, you're not going to look back and go, wow, banks earned a lot over the last year. You're just going to say that banks went from 8 times book to 10 times book, and that was a 40% relative move. So in some ways, you could be sitting here a year from now saying the fundamentals didn't change at all, but the valuation you put on it changed a lot because the Federal Reserve said, we're going to at least take our foot off your throat.
Oh my goodness, the valuation story, because they've risen so much, and the earnings story has come in to bolster it, and that's good. Right. But if it takes, okay, interesting. So on the bottom three, less interest rate sensitive, I'm assuming?
So defense.
Yeah.
I mean, I think that for, my base case is still that despite, we've seen a little bit, a retraction or an increase in initial unemployment claims and the unemployment rate actually going up a little, I think that's more rebalancing of the labor market. So I think that there are some concerns that, well, maybe this is the beginning of the end to the U.S. recovery that we've seen. I would bet that that's not the case. And if that's not the case, then there's not a lot of there in very defensive sectors like consumer staples and healthcare. And oh, by the way, even when you look at them, and I would add utilities to that, and when you look at them relative to history, they've got margin problems, they've got profitability problems, they've got all kinds of problems that they did not have in the 70s, 80s, and 90s. So when you look back and say, hey, defense actually worked during these situations when inflation was a little higher and we struggled from an economic perspective, these are not the same companies that they looked like at the time. What looks like that now is technology companies.
Right, yeah.
Right, technology looks to be both offense and defense, and not extreme on a valuation perspective, because on free cash flow, they're actually still in the bottom half of their distribution because they generate so much free cash flow that we certainly didn't see in the bubble. So on the bottom three, I'm going to give you 4: consumer staples, healthcare, utilities, and I'm going to add in energy. I still see that very, very negative risk reward in energy. And in fact, in the presentation I did to asset management yesterday, it wasn't just that crude oil might be sort of the writing on the wall in terms of that move that we saw down, although it's been reversed a little. Yeah. That move we saw down in crude usually foretells problems in the energy patch in terms of relative performance, but almost more importantly than the fact that there has really been no there in crude, I think along with inflation, is your starting point on fundamentals is quite good and turning down. So we saw the best profitability that energy companies have ever seen in my database going back to 1962. And we are still at top quartile levels, but those top quartile levels are falling and falling somewhat dramatically. That fundamental trend is really hard to overcome historically. Valuation doesn't overcome it. Even a rising crude doesn't overcome it. It's just a very difficult situation for energy to be an outperformer with high odds, right? So I'm not saying it's 0% odds, but with strong odds for me to want to bet on. So I actually think that there's potential downside from a relative perspective in energy.
Are you inserting the capacity story in that? Or is this all kind of a relative story?
It's part of the backdrop. It's definitely part of the backdrop. And when I look at, and I should put it up on the screen sometime, and maybe I'll put it up on my LinkedIn page. Yeah. When you look at crude oil production, or I should say crude production, crude oil is redundant. When you look at crude production in the US back to the 1920s, what you will find is, wow, boy, we produced more than we ever produced. And in fact, when you look at the data going back from, I think it's 1965 or something like that, all the way through 2011, the US was in a massive downtrend of just producing less and less and less oil. And now we've really reversed all the production that went away during the pandemic, and we're back to our peak production highs. So sure, you could say that shale decline rates are continuing to be high. At some point, you will produce less. And I would say I've been hearing that story for a decade, and I'm yet to see it in the data. So until I see it in the data, specifically on US production, I do think that you have to shift to a point where, look, it is very different this time, and this difference has mattered to the oil markets.
Fascinating. Just to go back to, there's a question coming in, which I'll put to you in a sec. Technology being both growth and value, would you go so far to call it what we used to call healthcare evergreen?
Yeah, I mean, I think that does. I mean, there are historically many sectors that outperform in down markets and outperform in up markets, right? We saw that in healthcare in the 80s. We saw it in consumer staples in the 70s. And the attributes that you look for from a factor perspective in that are that they can grow margins or improve margins in both scenarios, when the economy is weak or when the economy is strong. So it's almost like they have an idiosyncratic sales base that is less dependent on the economy. That is what I am seeing in the data for technology. So I do think it is an evergreen part of your portfolio. Now that said, if you own the S&P 500, you own a whole lot of US technology anyway, given that it's 30% the weight.
Fantastic. Okay, question rolling in. I suspect there'll be more of these as the months go on. So to what extent is the present market rally explained by the US election cycle?
So I know there are election cycle wonks out there, and I can show you average returns. And I think somebody told me just the other day that, you know, we are in for the seasonally strong period of an election cycle through the presidency, when the stock market has already been up. Look, I think that those seasonal trends, they give you odds around like 55-45. They're not something that I would bet on as an investor. So it's funny that you say, what does that explain the market rally?
Yeah, it could. Yeah, interesting question.
Part of the presentation that I just delivered to asset management yesterday was, is the stock market rally normal? And again, I might flip this to LinkedIn if people think it's interesting enough. When I look at the year-on-year rate of the OECD LEI or on earnings growth and the year-on-year rate of stocks, they're the mirror image.
Really?
Meaning that what we have seen in terms of equity gains has been reflected in what is an appropriate recovery in leading indicators and an appropriate recovery in earnings growth.
I mean, are we talking really about a soft landing, basically? Like, this is basically a soft landing. This is sort of...
Yes. Yeah. Yes. I think we landed, we already had the landing. The landing was either a hard soft landing or a very soft hard landing, whatever you would like to say. And now I would argue that we have landing and we are in the early stages of recovery, where profits are recovering much faster than GDP.
That is amazing. Okay, so does it feed into the election cycle, I guess is the question, or it's just happening because other stuff is happening, basically?
I think it's more coincidence than driven by the election cycle. But, you know, I mean, what you do see is a seasonal strong period during these times. So, I mean, maybe it's, you know, amplifying some of what is, I would say, fundamentally based and driven, but it could certainly be amplifying it.
Just to come back to the discussion of supply shock and how shelter fits into that and may well be the supply shock, ultimately, according to your research. The idea of crude, and you're, I think, bearish on crude, is that that's good for the consumer in other ways. Like if we're looking at sort of the other parts of the economy and the inflation story there, it should be good for the consumer.
Yes, it's definitely good for the consumer. And I don't know if I'm so much bearish on crude as I am that the S&P is much more likely to go up than crude oil is, right? So it wouldn't be against my thesis to the extent that crude oil rises through time. I don't think that crude oil needs to go down, but I think how this relates to the U.S. consumer is not necessarily the level of crude, although we all focus on what we pay at the pump.
Yeah.
And $4 is kind of like, ooh, that's high, and anything below $4, you go, oh, I feel better. But that said, when you look at energy consumption of goods and services, gasoline or otherwise, as a percentage of income, all of a sudden, that's your differentiator. So if crude oil goes up a little, that's perfectly fine, provided that incomes go up more on a nominal basis. And that is exactly what we are seeing. And we're certainly seeing crude oil come down, real incomes rise. And that's really the corollary. So once you see crude oil essentially do what it's just done over the last month or two, we may very well, if crude oil just even stays where it is, shift to a year-on-year decline again. What does that decline mean? Well, that decline means you've got less than 30% odds that the CPI stays above 3%. You've got very strong odds that real consumption growth accelerates. You've got very strong odds that real income growth accelerates, and you've got stronger odds of a stock market advance. So the give back that we have seen on crude, which may or may not be a function of OPEC, but the give back that we have seen on crude is a quite bullish indicator for stocks.
Okay, this is amazing. This all fits together beautifully. Love the thesis, and thank you for sharing it with us and helping us look at all the sectors on your radar. Denise Chisholm, have a great day.
You too.